And welcome to ETF Edge, your go-to place for everything's exchange-traded funds. I'm your host, Bob Pisani. We've often debated growth versus value here on ETF Edge, but there's plenty of other ways to slice and dice the investing universe. Our guest today reflects some of that diversity. Jeremy Schwartz is the global head of research over at WisdomTree, an old friend of mine. Jeremy Schwartz, as I said, global head of research at WisdomTree. Andrew McCorman is the managing director at Wallach Capital, joining us here at the New York Stock Exchange as well. WisdomTree has just launched its growth and momentum ETF, symbol WGRO. That seeks to capture the upside of aggressive growth with lower drawdowns on volatility. Let's talk to the man in charge, Jeremy himself. Jeremy, this growth and momentum ETF, it's an attempt to combine technical and fundamental factors and capture the upside of aggressive growth with lower drawdowns. It sounds like a pretty tricky maneuver. Can you tell us a little bit about how this is working?
Yeah, there's really two components, as you point out. There's the growth and the momentum component, and there's challenges with both sides of those equations with the way people traditionally do both factors. When you think about growth stocks, you often worry about people paying too much for growth. Certainly it's been a fantastic decade, even longer, 15 years for growth over value and sort of the FANG trade in particular, like the largest stocks in the S&P. But when do those, is there a way to think about better timing on when you get in, when you get out of the stocks? We worked with a group called ONeil Global Advisors. Bill O'Neill is one of the original pioneers of growth investing, looking for stocks in strong long-term uptrends, strong earnings growth, strong sales growth in rising trends, but that have pulled back recently, and so give you a better entry point. And also as a way to think about the exit point when things get overheated and there's too much crowding in a name. They try to find the exit as well. And so it's a really unique way of, we think, we'll manage the drawdown risk, as you said, on traditional growth stocks. And for momentum, if you think about the momentum factor, most academics talk about momentum as a monthly type of sort, and then you have the largest index from MSCI only rebalances twice a year. It really gets stale very quickly. And so we think we're solving a unique challenge on growth and momentum with a great partner with ONeil Global Advisors.
And we're putting up the ownership. I always like to look at the top 10 stocks because often in some of these it's 30, 40, 50% of the weighting. But looks fairly equal weighting. I mean, I'm looking across the board here, and it's an interesting collection of companies here. Generac, Enphase Energy, Roku, CrowdStrike, Deckers Outdoor, Pinterest, L Brands. There seems to be a mix of technology, which is about equal weight with the S&P. Consumer discretionary seems to be a bit overweight in this situation. I know generally how you're describing this as an equal weight situation, but it's an intriguing group of stocks that are here. Some of these are decidedly mid-cap stocks, for example.
Yeah, and so it is a factor weighting process that does feel equally weighted because of the way factor weightings tend to work. This also is one, as I mentioned, we'll have a monthly rebalance. It's going to be rebalancing again this week, so that mix of stocks can change by the end of the week. So it's one of those things that you have to constantly check back to see the latest holdings. But that's what a momentum fund that is trying to trade around the edges and find those better entry and exit points will do. So yeah, that speaks to how the power of this new updated process, that momentum trends will be changing, and they're trying to capture, those long-term winners that have pulled back recently at each monthly rebalance.
Yeah, Andrew, your thoughts on this? I think obviously people have been interested in growth and momentum for a long time, but weighting by growth has a problem. Eventually value might outperform.
Yeah, they're
for
working
example.
together right now. I mean, I think it's interesting, Jeremy. You said that. You have to buy growth on the dips. When are you getting a dip in growth? I mean, we had a 1.5% correction last week for an hour and a half. You know what I mean? For 2 hours. So that is going to be challenging. Obviously, getting the rebalance every month will help you with that. So I think that limits the potential upside only in because everything is growing right now. But I am a believer that we could have a pullback, a little correction, or certainly a correction of stocks, meaning growth is going to come out of favor, and that monthly rebalance should help. And of course, the equal weighting, like I said, will dampen the drawdown.
Yeah. Jeremy, this issue has been debated for a long, long time. This whole issue of how to weight these. Jeremy Siegel, a dear friend of mine, who's an advisor on your board, has had a tremendous influence on me intellectually in the last 20 years, has been arguing about this for a long time, about market cap weighted indexes versus fundamentally weighted indexes. And I explain to people that you can do this a lot of different ways. You can do it by earnings growth. You can do it by dividends. You can do it by momentum, sales. I've seen all sorts of slice and dices on this. I guess the question, and maybe you can lay this out for our audience, is there any evidence that weighting by fundamentals, for example, works better than weighting by market capitalization? And if so, what fundamentals really do matter?
You know, when Professor Siegel looked at the original research behind dividend weighting and earnings weighting, I was working with him on The Future for Investors that came out in 2005. This was the aftermath of the tech bubble, and he was trying to solve for how do you correct for large bubbles and large mispricings across time. And that was his real challenge was, you know, you had 10 stocks with triple-digit PEs in 2000, and he was calling, you know, big cap tech back then in 2000 the suckers, but one of his all-time greatest calls, and he went towards value investing and rebalancing back to fundamentals to help solve for that bubble. Now, you know, cap weighting does incredibly well in these growth-oriented markets that you've had for the last 15 years. So really where fundamentals start to work is in when things get really dislocated. You know, the more the markets run, the more expensive the markets get. You hear about the Shiller-Cape ratio getting towards really elevated levels. That's when thinking about an earnings approach will help you lower the PEs 20 to 30%. In small caps where you have 30% of the Russell 2000 not profitable today, you can get a 13 to 14 PE ratio when you weight by earnings, when you get much larger multiples in traditional indexes. So it really comes back to those long-term dislocations in the market where rebalancing to earnings and dividends would be helpful.
You know, this leaves my head spinning, frankly. Yeah. It's very difficult to figure out. So just looking back, long-term research, and Professor Siegel has done this, indicates that, for example, small caps tend to outperform big caps over long periods of time. Right. Value tends to outperform growth over long periods of time, and we're talking decades now. And yet, neither one of these have worked particularly well in the last 6, 7, 8 years. Right. We've seen the opposite actually happening. So what's a reasonable investor to conclude at this point? What should we wait towards just growth as we're doing here in momentum? Should we push more towards value under the theory that we're going to get regression to the mean? What should an average investor do who's trying to figure this out?
I think if your average investor is 35 years old, then they can stay the course with the market cap weighting if they're going to retire at 65 and a half. But if you're 60 years old right now, with valuations where they are, as they pointed out, and as Jeremy's research, you don't want to be on the wrong side of that trade when it happens. So it really has to come down to like your time horizon. The small cap point you made is great. Why do small caps outperform over time? Because small caps become mid caps and then they become large caps. So you're on for that entire growth cycle. But can you afford to be on small caps now at 62 years old? And what about the companies that don't make it? Can you wait? And then large cap, which when you have market cap weighting, right, how many small caps are up there at the top? You have a more stable, value-orientated stock that pays dividends, that protects on drawdowns, right? But this particular ETF we're talking about it's fine for someone that's young. You're going to get all that growth and upside, right? Yeah. And I believe the expense ratio is more than reasonable to justify being in this ETF, to be ready for some kind of downturn as well.
You know, Jeremy, if Jack Bogle was here, the founder of Vanguard, who I knew well, and who berated me many times for putting too much emphasis on active management, I can't help but think that he would say, you know, Bob, you want to buy value? Knock yourself out. But may I point out that if you just would have owned the S&P 500, you'd be up 13% so far this year. You know, there is an argument to be made that the average investor, even I have trouble figuring out these factors and what matters and doesn't matter in the long term. There is something to be said about some kind of simple indexing, even if you can argue that fundamentally weighting might be better than market cap weighting. The S&P is still no slouch here.
You know, you could own the world in one single fund, right? You could buy the all-world equities and not do a thing, and that could be all that you do. And that's a very reasonable approach. It'll give you the market's returns over very long periods of time. And so then the question goes, well, do you believe there are things that can do better and outperform the market? And, you know, I do believe in that fundamental weighting process that manages valuation risk, comes back to fundamentals once a year. Intuitively, you know, on a bond, the yield is the return. On stocks, the yield in some ways is the return. The inverse of the P ratio, the earnings yield, is a way to think about expected returns, and that could help you rebalance back to those valuations. But if you believe in factors like momentum, that systematically trading around this on a monthly basis can outperform, and the ONeil team has been doing this for 50 years, there's good evidence to try to overweight certain factors in portfolios as well.
I have to say, I knew Bill ONeil. He was a wonderful man, and I respected him a lot. And when people ask me, the biggest problem people have is they don't have a method. They'll sit and listen to people, and they'll start investing around, but they don't have any systematic investment methodology. If they want to try active investing, but they don't know how to do it. And that's the death, that is certain death.
Right, because in essence, they're following momentum with no discipline. Yeah.
Bill ONeil had a method. You can slim, as you heard Jeremy mention it, but it's basically a bit of technical analysis combined with a bit of earnings growth. I'm simplifying a lot, but at least it's a methodology. And when people used to ask me, is there a methodology I should follow? I said, look, I'm not in charge of dictating a methodology to you, but if you want to look at one that's been consistent over a long term, look at Investors Business Daily and look at Bill ONeil. At least that makes some sense to me if you're going to be an active investor. And Jeremy, I know you've been, this particular ETF follows those principles, which is why I thought it was so intriguing.